An interesting article a subscriber just sent me. Worried about retiring into a bear market? Here's what to do. From Barron's, Dateline June 27th, 2019, and originally posted on June 2nd, 2019. A lot of these articles get repurchased or repurposed. They'll be in Barron's, they'll be in like Market Watch, they'll be in Yahoo Finance, Motley Fool. A lot of Motley Fools are over here, over there, over there. It's interesting. So anyway, this is still Dateline 2019. So let's read this. I haven't read it, so it'll be interesting to read it together. Most of us spend our working lives saving for retirement. But retirement isn't just for grandkids and golf clubs. It's also a moment a financial plan is most at risk. The next wave of retirees may be particularly vulnerable. We are in a decade of a robust bull market, notwithstanding this week's 3% drop in the Dow and 2.5% in the S&P 500. I don't know if that's from the beginning of June or this last week. I don't pay attention, so I don't know. But either way, now, bulls don't die of old age, as they say, but they do slow down. And whether you're in the camp that the market is headed for a fall, a slow decline, or will keep chugging along, there's virtually no market strategist, economist, or investor who expects the next 10 years to look like the past. Investors, and new retirees in particular, need to prepare for much lower returns and protect themselves from a downturn. A market downturn early in retirement is much more damaging than one in a decade or so. It's called sequence risk. It's the one thing to project an average annual return for your portfolio of 6% over the next years, but markets don't move in averages. I've talked about it a million times a Sunday. And a good point here, the guy said the math is simple. 20% drop in your portfolio means you need a 25% just to get back to even. So it always seems like the drop is lower and the highs are higher in terms of what you need to overcome a drop. So let's see. We got an example here. Take the example of an investor who headed into retirement with $100,000 and saw average returns of 6% over 25 years. In the first scenario, the market rises in the first 8 years and then falls and rises. At the end of 20 years, that investor has nearly tripled his money to about $300,000. So again, first 8 year, it rises, the next year it falls, and the next it rises. So over the course of 25 years, she has averaged 6% a year. All right, again, up, down, up. The market drops, then the second scenario, the market drops 15% in the first year, 4% in the second, and 10% in the third before it rebounds. At the end of 20 years, that portfolio is worth zero. Wait a second. Does it say? That doesn't make any sense. Investor head into retirement. No, that doesn't make any sense. It's not saying we're not taking anything off this port. That doesn't make any sense at all. Take an investor who headed into retirement. Doesn't say anything about pulling money out. So no, this doesn't make sense at all. It doesn't say anything about pulling money out of it. Who headed into retirement with $100,000, saw an average annual return of 6% over 25 years. In the first scenario, the market rises. It doesn't say he's taking any money off. All right, well, that doesn't make any sense at all. No, because the second scenario ends up with the same exact amount as the first scenario because it doesn't take any money out. So when you're taking money out, that you get hammered. Not that. Yeah. Well, I'm glad. I should have probably read this, but now I'm glad I didn't because it shows you got to read the friggin' articles before you can. The people who write these articles got to read what they're writing because unless I missed it, and I didn't miss it. There's one thing to protect an average for the cover. The math is if your portfolio and if you've withdrawn money to live on, your balance is even lower and requires an even greater upturn to recover. But it doesn't say what they're pulling out. I don't know. I don't know what's going on here. I presume that person's taking out 4% a year, but I don't know. And then there's psychological effect. The early years of retirement generally require a bit more money. People often work part-time, socialize more, and travel. A sharp downturn, just as you're starting to enjoy retirement, can have a deleterious effect on your emotional health. But while there's reason to prepare, there's no cause for panic. And here are a few things you do. Not upset with the guy who sent me this. I do get frustrated with the guys who write these articles without obviously double checking to see where the scenario is. Because right now, I'm at a loss for why that is down to zero. My presumption is again 4%, but you can't. I'm sorry. If you and I have $100,000 and we're both getting 6%, and you're down and up and down and up, and I'm up and down and up and down, we're exactly the same exact place 20 or 25 years from now. I mean, it's because we both average 6%. The issue is the sequence of return risk when we're pulling money out. So this, I have to assume this guy knows that. The author, I mean, not the guy who sent me the article. All right, so one way you can do is boost your cash. I 100% agree with that. Retirees are cautioned against being too conservative. They need a good slug of stocks because they need their portfolio to grow. And they shouldn't hold too much in cash or short-term bonds lest their savings not keep up with inflation. But in the year or two leading up to retirement, it pays to increase your cash reserves. I completely 100% agree with that. This guy over at Accredited Investors advises clients to keep 3 years worth in retirement. Having cash means you don't need to sell stocks in a falling market. I 100% cannot agree with that more. Shift your asset allocation. There's a chance you'll live in retirement for 30 years or longer. While you'll likely need to grow your portfolio by having exposure to equities in retirement to keep up inflation, for the few years before retirement begins, it's tactical to reduce your stock holdings. I don't agree with that at all. While having more cash on hand covers your immediate expenses, increasing your bonds exposure will reduce the risk of a dramatic portfolio decline. I completely disagree with that. Again, but you know me. I think bonds are worthless. I really, really do. So what you want to do is go in, just like this guy here, Sean P. Smith said, have enough cash, 3 years. He says at least 3 years. I completely agree with that. And the rest should be in stocks. I mean, just have enough cash to see you through for a bear market. And the rest should be in stocks. You can do this too, by the way. I mean, if the market's going up in the first couple of years of retirement, don't touch your cash. Take that money out from your stocks. I'll do another video on that because one of my I haven't done that yet, where the market's going up, you pull from cash instead of pulling from stocks. That'll be interesting to do. So anyway, I might work on that tonight. Actually, not to put the video out there tonight, but just work on that spreadsheet. It's okay to be conservative during the most terrifying point in your investing life, says Rick Ferry, founder of Ferry Investment Solutions, who advised clients to increase bond exposure as retirement hits, sometimes to 60%. I've heard of Rick Ferry before. I don't remember where. I just don't agree with that at all. Let's see. Retirement research is way foul. When Kitces found your equity to bond ratio should look more like a roller coaster over the course of your life. Allocations of stock should remain high early in your career and then drop as you age, bottoming out a year or two before retirement at less than 40%. This equity exposure should slowly rise again to about 60% a decade or more after retirement to ensure your withdrawals don't eat away savings. I don't know, man. I don't quite think that's what Kitces was saying, have 40% less, only 40% of equities. But even if we were, I don't agree with that at all. And working a little bit longer. I got no problem with that. In fact, according to NBAER, the National Bureau of Economic Research, working 3 to 6 months longer can have the same effect on your retirement income as increasing your contributions by 1% over 30 years of employment. I did a video on that actually study, and I agree with that 100% unequivocally. But that doesn't mean you got to stay in your crappy old job. Maybe you find a different job of working. Just so you're not drawing down your savings, you're adding a little bit more to Social Security. I don't think these are mutually exclusive, which means retiring, i.e. taking Social Security and leaving your crappy old job. I think you can leave your crappy old job and go to something else, even if it doesn't pay you quite as well. You're still earning some kind of money, not withdrawing as much. And if the bear market hits, you're not pulling money out. That's the critical thing. All right, that's it. That was okay. I'm somewhat disappointed. I thought it might be a little bit better, but anyway, it's interesting. If you're retiring to a bear market, let's see what the comments are here. I always like to see the comments. I use Vanguard for IRA, like most companies, a money market where I put mine in troubling times. So this guy puts his money in the money market in troubling times. Is right now a troubling time? Who knows? He puts it into troubling times. When does he put it in? After the troubling times hit? Well, by then it's kind of too late, right? Where's the mention of stock dividend strategy? Surely these investment advisors know that some stocks pay dividends. I saw it. I actually did a video of that just the other day where we showed you my 5% rule versus stock dividends, and just taking the dividends off the S&P 500 versus the 5% rule didn't even come close. The dividends didn't give you enough money on the front end. It didn't. The 5% did, without question. So I did 4 different rules. I can't remember off the top of my head, but I forgot the fourth. I think it was 5% with inflation, 5% just whatever the portfolio was, the straight dividends, just taking the dividends, not reinvesting them. And then lastly was taking whenever the market went above the initial principal, we annuitize that. By far and away, the 5% without inflation adjustments just smoked all the other 3 by far. Dividend stream can serve as an income replacement in retirement. It doesn't replace enough income. It just doesn't. All right, let's see here. I'm surprised no one's pointed out boosting cash means you don't need to sell stocks in a falling market. It also means you have cash to bank. Okay. Why does no one notice that we should return to the Obama days when government existed to fund us? Okay. Good night. One wonders just how real this market is. We are lined up to pay 20 times earnings. 20 times. That means we go to someone and say, here's $100. I don't need it back for 20 years. I've never bought or sold any business for that price. Then there's the tweets. The market seems weak and fake. It can rise. I mean, come on, dude. The alternative is what? What are you going to do? Look at the 10-year Treasury bond as the alternative. And what is the 10-year Treasury bond doing today? And if you look at oh my lands, my friends, see that right there? 2%. 2%. How come we're looking at PE ratios in all this vacuum? You got to look at PE ratios relative to other things that are out there. Real estate, bonds, everything is expensive. So that's what the bubble did. The asset bubble made everything expensive. Let's see what this guy. How does working part-time in early years require more money? Well, because you're not making enough income to live on. That's why. So you got to get money from someplace. No one picked. No, I'm stunned. No one's got the obvious here that he doesn't talk about. I don't know. Maybe y'all can look at it and see if I'm missing something, but I don't see anything where he talks about distribution of any amount here to get the 0 and the 1 gets 294. Okay. So say the first scenario, okay, and saw an error at the end of the the market doesn't say anything. It headed into it in retirement with $100,000 and then had returns of 6%. It doesn't say anything about the distributions. That's just weird to me. Jeez Louise. I'm going to have to do some comments on here because that's nuts. All right. Anyway, if you want to look at this and let me know if I missed something, I'd be happy to see it. It's just strange. All right. Don't forget to subscribe and smash, and we'll see you next time.